Gold won't power your devices, it won't feed the hungry, nor shelter the homeless. But when markets crumble, it powers something deeper belief. What are safe haven assets? Why people trust them and when use them? My name is Ivan, and welcome to Magna Trade. A safe haven asset is a financial instrument or investment that is expected to retain or increase in value during times of market turbulence or economic uncertainty. Investors often move their capital into these assets to protect it from losses when riskier markets, like stocks, are volatile or declining. Safe haven assets rely not only on guarantees but on widespread trust. Investors turn to them during crisis because they believe these assets will preserve value when others fail. The belief is not born overnight, it's shaped by history, perception, and collective experience. Gold is the most prominent example of this phenomenon, and we will take it as the main safe haven asset. Its value is not dictated by a government or institution, but by centuries of human confidence in its worth. Trust within people, institutions, or financial assets is not spontaneous, it's built gradually through a combination of consistency, credibility, competence, shared values, and historical experience. In the context of safe haven assets or economic systems, trust is a complex construct supported by several interlocking foundations. Trust grows when something behaves reliably over time. An asset or institution that consistently delivers stability, especially during uncertainty, earns trust. Gold, for instance, has been a store of value for millennia. Its historical consistency is a major reason people trust it. Nothing tests trust like a crisis. Assets or institutions that survive turmoil and protect stakeholders often come out of crisis with stronger reputations. Gold, again, is trusted not because it yields income or utility, but because it has retained value during wars, hyperinflation, and recessions. Trust is also built on collective belief. The sense that others also trust something creates a feedback loop. Gold's value persists partly because a large and diverse group of people believe in it across generations and cultures. In many cases, trust is supported by laws, regulations, and institutions that enforce contracts, protect property, and ensure fairness. Many major institutions hold gold, most notably central banks like the US Federal Reserve, the European Central Bank, and the People's Bank of China, which keep gold as part of their foreign exchange reserves to ensure financial stability and public confidence. These institutional holdings reinforce global trust in gold as a reliable and a secure store of value. When systems behave in predictable and understandable ways, people are more likely to trust them. Markets, governments, or central banks that are transparent in their policies and decisions tend to retain investor confidence. Now let's take a look on some historical data. Here we can see a chart of the S&P 500 to gold. It's clearly seen that when S&P declines, gold either rallies or doesn't move at all. Let's review each spike. 1980. Gold rally. High inflation, a weak dollar, and geopolitical unrest drew investors to gold. The end of the gold standard made it more attractive. Speculation pushed prices to a historic peak. Black Monday, 1987. Let's take a closer look. Overvalued stocks, program trading, and panic triggered a sharp crash. Rising interest rates and deficit fears worsened sentiment. Automated selling deepened the collapse. Dot-com bubble, 2000s. Speculation in tech firms inflated the market. Cheap credit fueled investments in weak companies. When reality set in, stocks plummeted. 2008 financial crisis. The housing bubble burst due to risky lending and complex financial products. Default spread, freezing global credit. Major bank failures led to panic and bailouts. Even though at first gold followed stocks, later it showed most trends. COVID-19 crash, 2020. Lockdowns halted economic activity and supply chains. Markets crashed amid uncertainty and fear. Stimulus and central banks stabilized the recovery. In major financial crises, stock markets often experience sharp declines due to panic and uncertainty, while safe haven assets, like gold, typically rise or remain flat. Investors lose confidence in equities, and seek stability in assets less correlated with the broader market. Gold's intrinsic value and the independence from credit systems make it a preferred store of wealth during turmoil. This shift reflects a broader move away from risk investments toward capital preservation and volatility protection. Now let's review the most established safe haven assets. Gold, as we've discussed, often considered the ultimate safe haven asset. Gold is prized for its scarcity, intrinsic value, and historical role as a store of wealth across civilizations. In times of inflation, currency devaluation, or global crisis, gold typically maintains or increases its value. US Treasury bonds, especially those with short maturities. Treasuries are backed by the full faith and credit of the US government. Investors tend to flock to them during periods of market volatility, seeking preservation of capital and guaranteed returns, albeit at lower yields. Swiss franc. The Swiss franc is renowned for its stability and is often seen as a financial refuge during global instability. This reputation is underpinned by Switzerland's strong economy, political neutrality, and sound monetary policy. In recent years, a new contender has emerged in the safe haven conversation: Bitcoin. Once dismissed as too volatile and speculative, Bitcoin is increasingly viewed as a modern store of value, particularly by tech-savvy and young investors. With a fixed supply of 21 million coins, it offers scarcity akin to gold, while its decentralized and borderless nature makes it resistant to government control and inflationary policies. While Bitcoin's volatility remains a concern, its performance during episodes of monetary expansion, institutional adoption, and crises in certain countries has sparked growing interest. As macroeconomic uncertainties continue to mount, Bitcoin is gaining traction as a digital safe haven asset, one that may complement rather than replace traditional options in diversified portfolios. Let's summarize. Safe haven assets are investments that preserve or increase value during market turbulence, with gold being the most traditional example due to its historical trust and consistent performance in the past. Trust in such assets is shaped by crisis resilience, transparency, and institutional backing. Historical data shows that during major crises, like the 2008 financial crisis and COVID-19, gold often held or gained value as stocks fell. Alongside gold, US Treasury bonds and the Swiss franc are also considered reliable safe havens. In recent years, Bitcoin has emerged as a potential digital safe haven asset, offering scarcity and decentralization, though its volatility remains a point of debate. Thanks for your attention. Like and subscribe. Leave a comment sharing your thoughts on safe haven assets and suggesting what I should make next video about. See you in the next one. Goodbye.